And before we start, just observationally, I was out in the Middle East, last month, I think it was, and sitting down with like the sovereign wealth funds. And the mandate across the entire region, from Saudi to Abu Dhabi to Dubai to Bahrain to Qatar, is AI and blockchain. And not just using Bitcoin as a reserve asset, but also building the entire government infrastructure on blockchain, driving licenses, property deeds, the whole bloody lot. So it's it's fascinating to see. And then a lot of people say to me, well, if all of this money's coming in from the sovereigns, that may produce an outside return. And I'm thinking, well, if we're going from 3 trillion to 100 trillion, which is my estimate by just extrapolating out the trend rate of growth, you need larger players each time because the market cap is bigger, right? There's no way you're going to get to 15 trillion this cycle unless you've got bigger players. So it's kind of, I don't think it's what people think it is. I think it's just a function of the size of the market. The bigger it becomes, the more that those people are involved. And the more blockchain technology it gets used, the more it uses the alts for infrastructure rails, for new forms of compute and storage and all the other things that are coming. So I just thought it was interesting because everyone's like, oh my God, it's a super cycle because of this. I'm starting to err towards, well, we've talked about this before, a longer cycle, just because the business cycle is still below 50. So generally it takes a while to climb up. And then we use the GMI Financial Conditions Index, and that has a 9-month lead. And with the dollar breaking down, even today, it's starting to suggest that this may go even into Q2 2026. So it's like the whole cycle got shifted because rates didn't get adjusted and the dollar was sideways for a period of time. It feels that potentially there is a chance, and again, there's no guarantees in this world, that we're more like 2020 than we are in 2021. Or it's spookily similar to 2017. So let's go through some of your charts, some of your framework, because I think people are going to love to see the work that you put in. I don't know where you want to start with that deck or whatever you think the best narrative are.
Well, I think we could sort of start with just the actual risk framework that I built, looking at global liquidity first. So it's interesting what you're saying about, the sovereigns in the Middle East, because it's very much when you hear about the Middle East and crypto, it tends to be very, very Bitcoin orientated, right? So you've got United Arab Emirates and I think Bahrain are heavily investing into Bitcoin mining. And it just seems to be sort of very, very Bitcoin focused. Like you're not hearing the stories like what you're relaying here coming out about the usage in government departments. So that's extremely interesting.
I've always been bullish on the region because I think they're figuring out, what the world looks like without the oil and how do you invest the oil capital more efficiently. And they are just like, our future is AI because we've got endless energy right now. So we can do endless compute and data centers and all of that. That obviously plays for Bitcoin mining, but they have a lot of free cash flow and they want to become more modernized economy. So they're like, well, we'll build on blockchain rails and use AI in government. They're already using it in government, in asset allocation models, all sorts. So it's really interesting to see how fast they're moving. But yeah, you're right. Most people don't understand that they're going to be using a lot of underlying blockchain technology that's not just the storing of Bitcoin for a sovereign wealth fund.
Yeah, it's just such a contrast to some of the Western countries constraining themselves on the energy side, whereas in the Middle East, they're overbuilding their energy grids. And because of that, they've got just all this extra use. I mean, they can basically monetize all that surplus energy with Bitcoin. You can see where this is going to go in the next 10 to 15 years. The Middle Eastern countries are going to leapfrog a lot of other emerging markets, but, they could even well overtake some of the more established developed markets as well. Sort of bring it back to our friend liquidity. So what I've got here is just my version of global liquidity index, which is, aggregation of private credit through, global M2s or the global money supplies of large countries, central bank balance sheets, FX reserves, US net liquidity. Well, it's you can see that there's a very tight correlation, like depending on the data set you use, the regressions, the R squared or the explanatory factor of global liquidity on the Bitcoin price movement is very, very high. It's like one of the strongest relationships in financial markets.
Yeah, we get, using ours, we get 90%, 88%.
But what's interesting is that's a relationship, that's a sort of linear relationship over the time period, but there are periods where Bitcoin becomes hypersensitive to the changes in liquidity. We've had these periods where global liquidity goes sideways. Actually, Bitcoin usually tops before global liquidity tops out.
It's like when the rate of change of global liquidity slows down, it starts topping.
Because this has been driven by in the past, a lot of central bank activity as well. So central banks move very, very slowly, but the market detects when when break-even starts to break high, the market starts pricing in higher inflation, that the central banks will have to pivot. But they don't pivot on a dime unless it's an emergency when they're adding liquidity, but never when they're withdrawing. So usually Bitcoin will sniff it out many months in advance and we'll see the top form, and then global liquidity will roll over. But the contraction periods in global liquidity traditionally have only been sort of 24 months, so 2 years. And that was in 2014 and 15, then in 2018 and 19. The one that we've just gone through has actually been 3 years. So to your point earlier about the cycle being elongated, if you look at global liquidity here in white, it's been it was down sharply in 2022. And then we just had this sort of contraction period, like a wedge pattern that we've sort of been squeezing into and now breaking out of. So a longer contraction.
Buying that low in the first, that's what we did. And it worked really well. Back end of 2022, when global liquidity, it doesn't give the strongest price action, but I don't know, Bitcoin's up 6x since then. So it does work just by getting the bottom of it. But the breakout is when it really counts, right?
Yeah. So the tops are harder, but the bottoms are easier actually, because, at the bottom, it's usually sharp central bank actions. And that's the signal. You sort of don't have to sort of second guess that. And now that we're starting to break out, and you look at this sort of breakout of the last contraction period, and obviously 2020 was exceptional, so we're not looking to repeat that. But generally, if you look at the previous times we've come out of a contraction period, that has been what I define as like the super bullish liquidity regime. So, global liquidity can only contract or go sideways for a certain amount of time because the whole system is so indebted that their default risk rises. And also just the interest cost on debt becomes too excessive. So there's always an impulse to add liquidity. And so like a beach ball under the water, if you keep it down for too long, it's going to burst out, and we're starting to break out now. And so in the past, when we've seen a breakout of the previous all-time high in global liquidity, Bitcoin's sensitivity to the changes in liquidity triple. In my analysis, global liquidity goes up by 1%, Bitcoin usually rises about 7%. But in these particular regimes, that goes to 20 to 30 times. We got the breakout in global liquidity in early April as the markets were sort of tanking. So that was massively outperformed the S&P, massively outperformed the equities on a volatility adjusted basis, even though, it was down 30% and the S&P was down 20%. On a risk adjusted basis, massively outperformed equities. And so when global liquidity broke out in early April, Bitcoin rallied 40%. Global liquidity from that breakout is up about 2%. That's roughly what it has done in those previous bullish regimes where global liquidity breaks out to new all-time highs. You get a sensitivity factor that is factors higher than it typically is. And so for me, it's interesting that, we're not overbought, based on liquidity. Every new dollar that's created, whether it's even through like the US dollar weakening or depreciating is an easing on financial conditions, it all adds liquidity into the system or makes financial conditions better. And the relationship is strong. And so, I'm looking at now a market that is not overheated at all. In fact, it's doing what it should be doing and it's not doing anything excessive. I talked about a framework for sort of modeling the risk. What I did was I converted that relationship into a risk score. And the risk score for global liquidity is just this one here. It correlates pretty well to the tops in Bitcoin. So what you want to see, it's a rating system of 1 to 5, but I've also got percentiles, and we'll be publishing them onto the RV platform. So if people want to get a little bit more granular, like if we're at a 4, does that mean we're at 82nd percentile or the 88th percentile or the 90th percentile? Anything below a 4 is sort of just neutral, normal conditions. When we're at 4s, you have to start thinking about, okay, if there is chips to be taken off the table in Bitcoin or crypto.
And this is not necessarily the full cycle top. It can be sub-cycles within, right? So you kind of use it like a weekly RSI kind of idea, is like an overbought, oversold indicator.
An overbought RSI at the beginning of a breakout of a long-term downtrend is not a sell signal, it's a buy signal. In early 2024, so we got that read when Bitcoin was around 51, 52,000. It topped, within a week or two at sort of 73,000. So it doesn't catch the top. None of these are going to catch the top, but it tells you when global liquidity, when the price is stretched versus global liquidity. And of course
when you look at what's the other 10%, it's often the fear and greed, the elements where the market gets over ahead of itself, which is what you're picking up here, is like the deviation from the trend versus liquidity, right?
Just was so excessive in Q1 with the launch of the ETFs. It only corrected by 25, 30%, a pretty normal correction, but it did take about 6 to 7 months to unwind all that positioning. And then we also got an overvaluation read on the global liquidity risk score in December as well. And if you remember back then, you were talking about it, I was talking about it, like dollar was strengthening, like liquidity was tightening as we rallied very, very sharply into Christmas. And of course, then we had the fallout for the next sort of 3 or 4 months. So now where are we? We're at a score of 3. We are neutral. There is sort of that 40% rally off the lows of April is just the normal, the normal relationship playing out. The next score, the one we refer to, is called the derivatives risk score. Uses several inputs, mainly on perpetuals, futures. I'll be pulling in sort of options and other metrics when I can. The timing of this signal, you have to kind of ignore the 2020, 2021 market. That was extraordinary. Funding rates remained elevated for 12 months, and that simply was just a function of an immature market, and also the type of investors that were trading it back then. There's just no way funding rates can remain at sort of double digits, weeks and weeks and months on end. But if you look sort of more closely to what happened in 2022, it picked the bottom very, very well. And in early 2024, again, when the ETFs were launched, the actual top, the risk score of 5 came very close to the market top. And then again in December of 2024 as well. So this tells that other side of the story. So if you're overvalued versus global liquidity, is it driven by spot or is it driven by leverage and derivatives? If it's driven by the latter, that is a much more serious problem because that unwinds more quickly.
So looking at the liquidity risk score, we're neutral. Looking at leverage, we're kind of low, not even neutral, we're pretty low, which is suggestive as we go through more of your work that, we've got a potentially larger move at play here because we've got very little headwinds.
The positioning was so one-sided at this point, especially around an all-time high, like we got in this one here back in Q1. This was pretty much level with the old 2021 high. So you had old resistance, but you also had far too much leverage and positioning all one way right at the top. So it was just it was a recipe for a pullback. We don't have that now. So it's just, it's very, very muted, which is great to see. If we rally to 140, 150 fast and that all builds up, that changes the situation, altogether. But if we get a nice market move where leverage doesn't get ahead of itself and that positioning isn't sort of all one way, then this actually provides the support for higher prices and a longer cycle. Bitcoin goes up, open interest goes up. So there isn't much signal there. So for me, the signal is the rate of change.
Yeah.
And then there's funding rates and there's options and there's, options skew and there's,
Okay. So what next?
And the third one is network profitability risk score. So this is the on-chain metric. So this, there is like a multitude of metrics to choose from now. There's some great providers out there. I use Crypto Quant, Glassnode's obviously another one. There are others. And there's lots of different ratios and metrics that have been devised over the years that have been pretty good indicators of market tops. So this is really a synthesis of quite a few of them brought together. And this is the other part of the equation. So you've got global liquidity, which, just from a first principles basis, we understand drives asset prices. Leverage can ruin a trend and they can provide opportunity. So you've got to understand how the market is positioned on that front. But then you've also got to understand the on-chain spot holder basis. And so metrics like MVRV, NUPL, so MVRV is market value to the realized value, which is essentially, it's thought of as like the, measuring the cost basis of the entire network. What is everyone's like holding cost? And therefore, what is the unrealized profit between the market price and that cost basis? Another metric, NUPL, unrealized profit loss, does sort of the same thing, but it's sort of, it's bounded to 0 to 100%. And there's another metric, which I find quite useful, called SOPR, or Spam Output Profit Ratio. This tells you when a certain segment of the holder base, namely long-term holders, which are statistically significant, when they are doing things, either buying or selling in mass, then that has correlated very much to market tops and bottoms. All of these things together right now at a score of 3 is saying it's pretty, it's normal. It's not excessive. So the unrealized profit of the network isn't too high. The long-term holders aren't dumping coins, which they typically will at a market top. And so, that is not happening excessively right now. Again, if we go to 150, 160 quickly, then that could very much, spike up and we start getting a score above 4.
Well, let's look at ETH, for example, because ETH is starting to move. What are we seeing in ETH?
Fees are up 100% in the last month. Fees are a bit tricky because they're denominated in the, the underlying token price. The token moves, that also moves the fees as well. But it's correlating as well to, a 30% increase in DEX volumes. Fees in ETH are up 60%. So it's pretty substantial for ETH. And
sorry, are the fees in ETH going up because of the restructuring of ETH to accrue more to the base chain? Is that what's going on here?
No, I think it's just it's a combination. Definitely activity on the chain has increased. So that's what you see, from the daily fees in sort of native ETH, but it's also partially due to price as well. So there's sort of dance that activity and price do together. Sometimes they're very, very sort of intertwined. You don't know which one leads what, but generally I would say that, you can see that overall activity on the chain has definitely increased. And that is a major driver of the increase.
It's also interesting because, I still like the daily active addresses way of looking at things as well. And you can see how little it grew in 2 years, 4 years. It's only grown by 2%. ETH has been relatively dead compared to, if you were to compare daily active addresses growth across different chains.
It's also the other thing is positioning. No one owned ETH. It was probably the short side of a lot of pairs. And if you look at the ETF flows now, they're starting to really pick up. So, combination of increased activity, timing in the cycle, and just so much negative positioning or underweights.
Let's have a look at any of the others, because observationally you've looked at this stuff. What are you finding amongst the chains that is interesting?
When you look at, the total value that a user is prepared to pay, which includes the base fees, all the tips, and the MEV, Solana looks extremely strong. Relative to ETH, undervalued. In the last couple of months, the activity on BNB, which I kind of ignored for a while, has really started to pick up as well. And also Tron. It's doing around $9 million in fees. And again, speaking to Dan Smith from Blockworks yesterday, I asked him the question, it was like, how much of that do you think is wash trading or is, fraudulent activity? And he's like, he's tried to unpick it every single which way to try and answer that very question. And he's sort of come to the conclusion that no, there could be some, but at that level, this is like legitimate transfer value. There's very little activity. There's, the DeFi activity on Tron is, very, very small, which is
it's all stable coins then.
Yeah. It's all Tether and Tron's native stablecoin. If you look at it from an ecosystem standpoint, what you want is, Metcalfe's law and Reed's law. Number of interconnections and then sub-communities creating, like Bitcoin has with Lightning and mining, and Tron is very uniform. It's a stablecoin platform. So it doesn't have some of those aspects you look for it from a network effect, but it does the one thing, and it does the one thing very, very well. And so, it makes more from fees alone than any other chain. So, if you look at the chart on Tron, it's exceptional. It is, it's up and to the right with very, very low volatility. So it doesn't move as much when the market goes up, doesn't go down as much when the market goes down. And, it's got a massive burn. So Tron looks, pretty interesting for the rest of the cycle. It's probably
how about Tom? Tom's got this weird thing that it's got a massive network, but it's got to get that network to use its native token. Are you seeing anything in Ton at all?
There was pretty good on-chain activity in the middle of last year during the sort of pullback bear market that we had. I thought that was interesting, but that kind of leveled off. So there's a lot of incentive-driven activity, which hasn't really followed through. I think it's got a ton of potential. I mean, it's got a captive almost 1 billion user base. The activity, the adoption metrics I'm looking at, it hasn't come up in like the top quintile of assets in the screens that I've been running.
And what about Sui after the Cetus hack?
It's leveled off. It pulled back, and then it sort of regained about 50% of the pullback pretty quickly. But it hasn't got back to the highs that it was doing in, when was the hack? It was probably sort of mid-May. So I would say that the performance since the hack has been robust. The momentum, it's the rate of change, and Sui's rate of change of network activity was really moving Q1. And it was the reason why, I wrote about in one of my reports in April where we doubled down on it, because during the bear market, as things were capitulating, TVL, stable coins, DEX volumes were all going up. And there was there was two chains that were doing that at the time. And the other one was Sonic, which was heavily incentive driven.
Yeah, it exploded out of that low. I mean, it was shocking. It moved so fast.
Yeah. And so then we had the hack and it slowed it down. But it still looks fine for the rest of the cycle.
How does Hyperliquid stack up on the way you look at? I don't know if you're looking at that yet, but
and so it's starting to really become a competitor even against some of the sexes as well. What did Hyperliquid do? They came to market with no VC funding, a massive, fair launch public offering of a large part of the issuance, about 30%. And so finally we had a token who actually had product market fit that gave the investors, the public, the right to access it early, right? And didn't sort of not sell out, but like have massive VC insider holdings.
Also their burn mechanism, their token economics are good.
Absolutely. And that's driving price.
That helps. Yeah, that's right. Because it's essentially share buybacks. You're rewarding your token holders for activity on chain.
Yeah. Yeah. It's the perfect tokenomics model, right? Maybe not perfect, but like it's been one of the best ones that I've seen so far. But it's all for naught if you don't have product market fit. But they have a great UI and they have a great, the great business, and that put together is, you're going to see it, I think, do rather well. There's a massive amount of unlocks that happen around November, so people have to be aware of that. And the asset's getting, pretty chunky relative, so that's also a factor. But I still think, based on the growth that we're seeing, that it's got a couple of multiples from here.
It feels that the market is not really positioned. Liquidity is rising. We're getting to the point where the liquidity multiplier in token prices goes up. We're also getting to the point of alts outperforming Bitcoin, where market breadth is improving. We've got activity across the space growing. We've got the narrative of people trying to build big things or storing wealth in Bitcoin or building big things on other chains. Smells to me like there's a yellow fruit hanging around here somewhere.
It's definitely getting fruity.
It's definitely getting fruity. I don't know where Bitcoin gets to by kind of August, but we got a decent run. I think we'll be surprised to the upside in how fast stuff runs. Then we'll cool off for a bit, but and now Global M2 is rising again, and it's got extremely good correlation. Now, it won't be perfect all the way, but it just feels to me that from here on in, basically we've got a really good run. And structurally, going through your very detailed data-driven approach is telling me the same thing. It's kind of adding to my conviction that yeah, we're about ready.
Yeah. And if then, those things change, leverage spikes or something else happens, hopefully we'll pick it up in those risk scores.
Yeah, and leverage will spike because people love sex and leverage. They're the two things they love the most in the world.